André Roberts from Invesco, welcome to the Growth Symposium.
Oh, thanks so much, Drew. Cheers.
In a nutshell, what is the factor approach to investing?
Right. Okay. Factors, what are they? They are characteristics of companies that explain the co-movement of stocks. And as a systematic approach, you want to try to get good exposure to the factors that are rewarded. And we believe they are value, quality, and growth. And in quant, we think of growth as momentum. Okay, and good diversification across those factors that you get some return from, but equally avoiding the factors that are unrewarded, so risk factors.
And they can apply to every market or every company.
Yes.
Are they more prevalent in driving the performance of smaller companies versus large ones?
I think that's a fair statement. In small companies, the inefficiencies are there. There's not less. They're not as well covered, and so there's probably opportunity to do a higher breadth coverage of small caps and find those gems that not everyone's looked over.
And investing based on factors or being wary of your style exposures, does that increase the level of kind of predictability around the core of a portfolio?
Well, that's the thing, right? You don't really have a perfect compass on which style is going to outperform and when, right? And you know that these factors have good long-term characteristics, but you acknowledge there's going to be short-term ebbs and flows. And so that diversification, trying to get exposure to all factors in a sensible, balanced approach, improves the predictability, but more so even in those smaller cap markets where there's inefficiencies to capture.
And would you say there's one most prevalent factor within smaller companies?
Look, I acknowledge that, if you looked at a universe of small companies, there's probably a value-ish tilt there, but does that mean it drives the returns? No, I would say that momentum and growthiness, if you like, as we express as momentum, is by far and away the most important driver of returns.
Is that kind of value exposure driven by we're talking Australian small caps?
Yeah, that's right.
The fact that mining and energy.
Well, that's right. So you're getting that complementary thing. You've got value-ish names in banks, as we heard earlier in the Symposium, as well as mining because of the cash flows. So you're going to get value-ish characteristics, but it's momentum that we feel is a key factor that you want to get exposure to, complemented by value and quality.
Yeah, and how important is it to identify the economic cycle and the factors or the market cycle?
Well, it's important to acknowledge it, right? Because you appreciate that macroeconomics does trend, and there's long periods of time when, say, commodity prices, as we've seen, do dominate affairs, and so you want to have exposure to names that are in that space. So you don't want to have a blinkers-on approach to not playing in resources, but you appreciate that macroeconomics also can be a challenge to get the timing right. So that comes back to that factor diversification idea, where you want to be able to have a breadth of factors to avoid the shifts in macroeconomics and having that being a negative thing on your portfolio.
And with that in mind, are there other areas where a lot of smaller company strategies go wrong?
Well, I guess a couple of key areas that are a bit more unique to smaller companies is about stock-specific risk and building really concentrated portfolios. You want to have better diversification if you can. You just don't know how some of the outcomes are going to come. So diversification of stock-specific risk is really important, and in line with that, concentrated portfolios can be less liquid. Right, so that's another area that small caps is particularly prone to having problems, where you get liquidity risk and you might have months of average daily trading volume required to shift a position, and that's a trap. If you had a higher breadth approach, lower concentration approach, you can diversify the liquidity risk as well as stock-specific risk.
André Roberts, thank you.
Thanks very much, Drew. Good to speak to you.